Good morning, and welcome to Futures iTrade Show, a virtual trade show that you can attend from the convenience of your desk. My name is Ginger Zala. I'm publisher and editorial director of Futures Magazine. We are very pleased to bring you this event and hope you can take advantage of all aspects of it. This, of course, includes listening to the interesting speakers we have here in the conference hall, as well as visiting the exhibition hall where you can learn about and research new products and services all at the click of your mouse. Our Resource Center will provide you much in-depth information on all our speakers, as well as resources you can use in your product and service tour. And remember, the show is archived for 3 months, so you can listen to the presentations as well as visit the exhibition hall on your schedule. This afternoon, I have the pleasure of introducing Al Brooks, who will present Trading the Best Price Action Setups. Al spoke at our May show and was such a big hit, we asked him to speak again. He is self-taught, self-made day trader who for 20 years has traded for his own account. He started out in medicine after attending the University of Chicago, where he also did his ophthalmology residency. But even in those early days, the pull of trading was with him as he contemplated going to work on the Chicago Mercantile Exchange. But he continued his medical career, teaching at the Emory University School of Medicine and setting up a practice in Los Angeles. Although having authored many medical papers, Al has just completed his first trading book, Reading Price Charts Bar by Bar, due out next year through Wiley. After his presentation, Al will be happy to answer questions, so feel free to send them in throughout. You'll see the Ask a Question tab on the left side of your screen. Also, during the course of the presentation, the Enlarge Slides button is on the Slide tab. Once again, thank you for attending Futures iTrade Show, and please join me in welcoming Al Brooks.
Thanks, Ginger, and I also like to thank Futures Magazine for giving me this opportunity to talk about some of the things that I do. My name is Al Brooks, and I am a physician, and I stopped practicing medicine about 20 years ago to become a day trader. I have a few things that I want to say right up front. I've published a number of articles in Futures Magazine over the past year and a half or so. And I enjoy getting emails, but I've been getting hundreds and hundreds of them, and I answered, well over 100 of them, and I simply don't have the time to answer them anymore. So I went ahead and decided to put what I do into a book, and it will be coming out sometime this winter, and the title is going to be Reading Price Charts Bar by Bar, the Technical Analysis of Price Action for Serious Traders. And Wiley is publishing it. In fact, I'm in the middle of editing. They sent me the edits to look at yesterday, and I hope that it answers everyone's questions. Okay, now what is price action? It's a very loose term, and it means just about anything that you want it to mean. When I think of price action, I just think of any change in the price on any chart or any time frame. And it can be a single tick. A single tick on a monthly chart usually doesn't mean much unless it's a failed breakout of a swing high or a swing low point. But a single tick can mean a lot on a 1 minute chart or a 3 minute chart where the bars may only be 3 or 4 ticks long. Why do charts look the way they look? I used to always wonder about that, and I guess I had the same thoughts that everyone did at one time or another, that there's a lot of manipulation by big firms like Goldman Sachs and other institutions and hedge funds, but that's simply not the case, and I'm absolutely convinced that it's not the case. Charts look the way they look because that's how charts look when you have a huge number of traders trading with almost an infinite number of methods and reasons for their trades, and when it all gets put together, you get charts, the charts that you see every day, and they're the same in all time frames, and they're the same in all markets. If you have a very thinly traded stock or a very thinly traded market, there can be manipulation. But if you're trading huge markets like bonds or currencies or the spiders or the E-minis, there's not going to be any manipulation. Now, As many of you know, I'm something of a trading hermit. I pretty much stay by myself, and I don't talk to other traders. During the day, I don't watch TV. I don't read business news. My blinds are drawn. I don't take calls. And, it's a job, and I view my job as taking money from other people's accounts and putting it into my account. And, it's pretty boring, but it works and it pays well. I'm not interested in anyone's opinion. I'm not interested in any distractions. I don't want to watch CNBC. I don't want to watch Jim Cramer. I got to say, I do watch Fast Money a lot of times after the markets are closed, simply because they're entertaining and they are traders. When I trade, I'm always looking for patterns, and there are many types of patterns. There's never a perfect pattern. You pretty much only get something that's close to perfect, and in trading, close is close enough. If you see something that resembles a pattern, it's probably going to behave like that pattern, and you should trade it as if it is that pattern. For example, on this particular chart, there's a double bottom bull flag here, and it's not a perfect double bottom because the second bottom is lower than the first. But again, close is close enough, so I would trade it as if it was a double bottom. Now, a couple things. A lot of people think of traders as gamblers, and the best traders are gamblers, but you got to remember that most gamblers go broke. So you have to be more than a gambler. You have to be a smart gambler. All traders are addicted to trading. I certainly am addicted to trading, but most people who are addicted to trading slowly blow their accounts. And again, you can be a gambler, you can be addicted, and you can make money, but you can also lose money if you're not following a plan. Now, you can take 20, 30, 40 trades a day. If I were you, I would not do that, especially when starting out. If you just think about the math, if you're able to make just a single point a day, and you're able to do that consistently every day, it makes far more sense to work on increasing the volume of your trades than it does to increase the number of trades that you're making. Because if you do the math, if you're consistently averaging 1 point a day and you're trading 10 contracts, that's $100,000 a year. If you're trading 100 contracts, that's $1 million a year. And if you're making 4 points a day consistently, that's $4 million a year. So the key to me is volume and not the number of trades. It makes much more sense starting out to be very selective and just look for 1, 2, or 3 or 4 trades on the 5-minute chart every day. If you're really doing this to make money, you've got to be really patient, and you've got to take it seriously. If you're just out there firing away at everything that looks like it's a possible trade, over time you're going to lose and you're going to blow your account. What are the 2 most important characteristics of great traders? In my mind, the number 1, you hear this all the time, is discipline. There's never just this time, maybe it will work. You don't violate your rules. If something doesn't look right, don't take it, because the mathematics of that, the just this time, maybe it will work philosophy are against you. You'll win some of the time, but over time, you will lose money. Also, being patient is extremely important, especially if you're only going to be trading 2, 3, or 4 trades a day. It can take hours for a good signal to set up, but it'll come. They come every day. There are several really good signals every day, and if you're patient and you wait for them, you'll catch them and you will make money. A trade is never overdue. It's never the market has never gone too far, and therefore it's due to reverse. That kind of mentality is value trading. Oh, it's a good value now, so I should buy. And that's fundamental trading. That's basing your trades on fundamentals. And as a day trader, you cannot be a fundamental trader, because fundamentals operate on a different time frame. They operate on the time frame of months to years, and a day trader is operating on the time frame of minutes. So value and fundamentals are meaningless. That chart, by the way, that I have in front of you right now is a monthly chart of the E-mini. And in fact, I did buy that DBP way back there in 2003. That's a double bottom pullback entry, very classic entry. My setup, okay, I'm a minimalist, and I right now have my notebook and computer in front of me. It's a 15-inch screen, and I have one chart, and it's a 5-minute chart, and I usually have a 20-bar exponential moving average on the chart, and that's all that I need. There is, boy, if you were here, I could show you that there is an unbelievable amount of information on this chart. Every bar is telling you something, and I can't process more than what I'm seeing right there. I don't want indicators. You don't need them. If you can read the price action, indicators just give you more to analyze, and if anything, it's going to slow you down, and you'll be paralyzed in your ability to place your orders because you'll be spending too much time trying to analyze things that really aren't helping you. All that you need is right in front of you, just a simple bar chart. I also have a second screen of 6 bar charts of stocks, and I typically look at this several times a day for swing setups. I try to make 50 cents or $1 or so once or twice a day on a stock swing. But I would recommend against doing that. I only do it because sometimes during the day I get bored, and I know that there are good setups on the stocks, and for the fun of it, I just go ahead and place a swing trade. Plus, it's profitable, but it's not as profitable as the E-mini trades. Now, if everything works on all time frames, why am I trading the 5-minute chart? A 5-minute chart recently would have 15 trades a day, 15 reasonably good trades a day, 4 or 5 excellent trades a day. The 3-minute chart has 25 trades a day, and the 1-minute chart might have 40 or 50 trades a day. And if my techniques work, why don't I simply go down to a smaller time frame and escape the boredom, because I'll be having trades every few minutes. The reason is I can't do it. I've tried it. I've tried it many times over my 20 years, and I end up cherry picking too much, and I end up picking too many of the bad cherries. On the smaller time frames, especially on, for example, the 1-minute or the 3-minute, the entries happen so fast that I cannot place my orders fast enough to catch the best entries on too many of the trades. So I've decided that instead of worrying about catching every little trade, even though I see them, I'm physically unable to place the orders fast enough to catch all of them. Instead, I focus on working my volume on the 5-minute charts. And to me, ultimately, that is much more profitable and certainly less stressful. Again, a 5-minute chart has a lot of good entries every day if you know how to read price action. And again, you don't need indicators to see them. They're pretty self-evident. Now, the market is either in a trading range or in a trend, and this is true on all time frames. And as you can see here in the red box on the right, the market is trending, and in the 2 blue boxes, it's in a trading range. Now, it's also every bar is either a trend bar or a trading range bar. A 5-minute bar, for example, is made up of lots of ticks, and within that bar there can be a trend or there can be a trading range. And what I do is I look at the size of the body, and if it has a pretty good sized body, I call that bar a trend bar, and if it has a fairly small or non-existent body, I call that bar a doji bar. And I look at a doji bar as a 1-bar trading range, and I look at a bar with a reasonable sized body as a trend bar. And on this chart, I marked off with the letter D, bars that are doji bars or 1-bar trading ranges. And the definition's soft. Sometimes a bar could be, if the body's small, you can call it a trend bar, you can call it a doji bar, depending on the context. But in general, if something looks like a doji bar, I think of it as a trading range. And why is that important? Well, here's an example. You see on the right there is a small-bodied bull reversal bar, but it's a doji bar. The body is really pretty small, and also the prior 6 or 7 bars have been straight down. So you're in a bear phase. Now, I said a doji bar is a trading range. So you're in a bear phase, and you have a doji bar or a trading range bar. Do you want to be buying above a trading range in a bear market? And the answer is no. And what happened here was the market went one tick above the high of that doji bar and trapped a bunch of longs, and then immediately reversed down, and the bear continued. And so a doji bar in a trend is just a flag. So in this particular case, you have what looks to be a bull reversal bar, but it has a very small body and a very large tail. That is a 1-bar bear flag, and I would not be looking to buy above its high. Now, how do I enter? I always enter on a stop at 1 tick beyond the signal bar. The signal bar is the bar that that's talking me into the trade. It's my setup. It's the last bar of the setup or the pattern. So, for example, if I want to sell, I will place an order to sell at 1 tick below the low of that signal bar, because I want the market to be going my direction when I enter the trade. So I at least want a minimal trend occurring as I enter, because I always want to be going with the trend. I also, in the E-minis, scalp some off. I place a limit order at 4 ticks below my entry price to take some profits. Sometimes, if the market is just sideways and choppy, I'll scalp the entire portion. Other times, if I feel like there's a really great reversal setup, I won't scalp any. I'll let my entire position run, and that can be very, very profitable. Obviously, if you want to take 4 ticks out of the market, you need a 6-tick move, because the first tick beyond the signal bar is where you get in, and then typically to get out on limit order, most of the time the market has to go 1 tick beyond your order for you to get filled. So that gives you a total of 6 ticks. Stops. Now, initially, my initial stop is 1 tick beyond the signal bar. So, for example, if I shorted this L2, this low 2, theoretically I would place my stop at 1 tick above the high of that L2 signal bar, that bar that's poking above the exponential moving average. After the entry bar closes, I'll then move my stop to 1 tick above the entry bar. And then after I scalp out of 4 ticks, in other words, after the market has moved 6 ticks, I'll move my stop to break even on the balance of my position. Now, I also use money management stops on a typical day, not like what we've been having for the past couple months. I will use a money management stop of about 2 points. I decide early in the day what size money management stop I will need, and I can usually tell by the first trade or 2 of the day. Whatever size money management stop was required on the first trade or 2 will usually be the maximum money management stop that I would need for the rest of the day. When the range is huge, as it has been for the past month on many days, sometimes I'll use an 8-point stop, 4-point stop or 8-point stop, and sometimes I'll use a 2-point target, or sometimes even a 4-point target. There was 1 week back in the middle of October when the market was moving, 400, 500 points on the Dow every day, and on that day I cut my position size down to just 1/4 of normal, and I increased my stop to 4 times normal, and I increased my profit target to 4 times normal, in other words, to 4 points, and I ended up making more than my average daily nut during that week. So don't worry about reducing your position size, and don't be afraid that, oh, I'm going to make less money. If the market is trading in a very big range, you'll end up making about the same as you would on any other day. Okay, now this day is a particularly interesting day. It just looks like a typical day until you look at the price scale on the right. And what you see is, instead of a normal average daily range of about 20 points, the daily range here was almost 100 points on the E-mini. And this is an example of a day in which I had to greatly reduce my position size and greatly increase my stop and my profit target. Now, if you're about to place a trade, let's say 2 lots in the E-mini, and you don't place the order, it's probably because you're scared. And if you're scared and the ranges are too big, I strongly recommend switching over from the E-mini to the SPY, the spider. The SPY trades tick for tick, almost identically with the E-mini. You know, the shape and the entries and exits are all the same. One E-mini contract is identical to 500 spider shares. So if you're afraid to trade 1 or 2 E-minis on a big day, just go ahead and trade 100 spider shares. That way there, at least you'll be trading, and when the range is big, you'll be surprised that you'll end up making several $100s or more just trading 100 spiders. At least you'll be trading. So whenever you're afraid to trade, I would always just go back to the spiders and go down to a small size, like 100 or 200 shares, until you can build your confidence again. Also, on big days, you've got to be trading. So go to the spiders if you're finding yourself not taking trades. Now, something about those break-even stops that I told you. After you take off your scalping portion, you can see the red arrows here on the shorts, and there's a green arrow down at the bottom on the long. You'll notice that if you move your stop to break even, you'll have several trades a day in which your stop will not be hit, and you will catch a very, very big swing. And you stay in the position until there's an opposite signal, or until the market goes dead and you don't know what to do. So that swing portion, even if you just catch one swing a day, a lot of times a single swing portion can generate more profit than all your scalps combined. So if you're at a potential major reversal point on the day, it's really valuable to swing part of the trade. Now, you probably know from the articles that I published in Futures Magazine that I rely a lot on trend lines and trend channel lines. Here, I drew a trend line from bars 1 and 2, and then I wanted to find a trend channel line, which is on the opposite side of the trend. So on a bear trend, the trend line is sloping down and to the right, and it's above the highs of the bars. And the trend channel line also slopes down and to the right. It's usually basically parallel to the trend line, and it runs along the lows. This particular trend channel line I created by making it a parallel of the trend line from bars 1 and 2, and then I dragged it down to whatever bar in between bars 1 and 2 would be the one where that trend channel line would contain all the price action between 1 and 2. So I'm just looking for the, I'll put it at the lowest point where none of the other bars between bars 1 and 2 penetrate it, and then I'll just watch later in the day for the market to poke through that trend channel line as it did at bar 3, and then look for a reversal setup. And here there was an inside bar with a bullish close, and that's a reasonable reversal setup. And so that's certainly good for at least a scalp. Okay, I'm also often asked if the Globex is tradable, and if I take trades in the Globex and the overnight sessions. And yes, it's very much tradable. And sometimes I take trades in it. A lot of times I don't, because a lot of times I do get 1 or 2 tick slip, usually 1 tick slippage if I'm trading any kind of volume, and I hate slippage, especially since I'm so much of a scalper. I can't afford slippage, so I will only trade in the Globex if the market is moving and it looks like there's good potential for profit. If the market is sideways, I will not trade it. Now, a really important point in all of trading is the market often makes 2 attempts to do something. And if it fails twice at doing something, it will usually then try to do the opposite. So, for example, you're probably aware that I do bar counts, and I use things that I call low 1s and low 2s. I'll talk about them in a minute. But anyway, there's an L2 here. The market made 2 attempts to rally. It was a 2-legged rally up, and a lot of times, so it made 2 attempts up, and I'm looking at that as a possible failure. And when the market fails at 2 attempts up, in other words, it didn't make a 3rd attempt up, a lot of times you'll have a good move in the opposite direction, so you'll have a good sell-off. And then that LL, that lower low at the bottom, I'll talk more about that later, but there are 2 attempts down that failed, and that led to a rally. Now, as far as the bar counts go, many of you probably know that I'm always thinking in terms of high 1s and high 2s and low 1s and low 2s, sometimes 3s and 4s as well. But here I'm talking about my high 1s and high 2s. If the market is sideways or up, I'm looking to buy pullbacks. And the first bar that has a high above the high of the prior bar in a pullback is an H1. And the second occurrence is an H2. And on this chart, I have labeled H1s and H2s. So you can see the H1s have a high above the high of the prior bar in a pullback. And most of the time, the safest thing that beginners should be doing is looking to buy H2s in trends, which, an H2 in a trend is the end of a 2-legged pullback. Oftentimes it's at the moving average. If the market is extremely strong and it's just going up, 3, 4, 5 bars in a row, then I'll look to buy an H1. I'll talk about that a little bit more in a second. Okay. A micro trend line, it's a term that I use, and it's a trend line drawn over usually 3, 4, 5 bars, where the bars all seem to come to the same trend line level. And then if you have a break, for example here in a bear, if you have a 1 bar or a 2 bar break above that trend line, I will look to sell below that bar, because that's an attempt to break above a tiny trend line. And if you make an attempt to break above a trend line, and then the next bar immediately goes below that breakout bar, that breakout has failed. Most of the time, those are L1 shorts. So in a trend, I'm always trading micro trend lines. I'm looking for failed breakouts, and then I'm entering with trend. So in a bear, I'm looking for a break above the trend line, and then I'm shorting below the first bar that has a low below the prior bar. Now here's an example of a micro trend line and a bull. You had 4 or 5 bars up in a row, all with lows that look like they would be hitting a trend line, and then you had a bar break below the trend line. I'll immediately place an order to buy at 1 tick above the high of that bar, and that's an H1, and it's almost always good for at least a scalp. In a down or a sideways market, I'm always looking to sell rallies, and the first bar in any pullback that has a low below the low of the prior bar is an L1 or a low 1, and the second occurrence is an L2 or a low 2. And again, most of the time you're looking to short L2s at the moving average, If the market is very, very strong and you have a micro trend line, then I'll look to short an L1. There's one little L2 in there that has an asterisk next to it, and if you do the actual count, it's really only an L1. But 2 bars earlier, there was a bear doji, which effectively ended the first small leg. If you dial down to a 1-minute chart, you'd see that that is actually a 2-legged move. So I would trade it as if it was an L2, even though it's an L1. You don't lose sight of the goal. The goal is to be looking for 2-legged pullbacks, even if technically it's only an L1. Again, the counts are not absolute. You're just looking for something that looks like a 2-legged pullback, even if there is only an L1. Because if you think about what's going on, it's an L2. Here down, that L2 that I'm referencing, the second one, it's really also a micro, not a micro trend line, but a full trend line breakout from the high of the day. You have a 4-bar rally that broke above the trend line. I didn't draw the trend line in, and then immediately afterwards, that L2 was the failure of the trend line breakout. So, the first break above a trend line, you always place an order to sell 1 tick below that breakout bar, because breakouts against trends usually fail. If a leg runs too far, just start the count over again. So you can have a bear market that keeps going down and down and down, and there'll be an L2 and then another L2 and another L2. I'm only looking for pullbacks, and I'm only looking for reasons to get in pullbacks. And I don't think back, oh, there was an L2 10 bars ago and another one 20 bars ago. I'm just looking at what's taking place right now. And every time there's a new move, I just start my count over again. This is an interesting thing. Look at on the far right. You have a failed high 2. You had a bull bar, a bear bar, and a bull bar. So that's a 2-legged pullback, and in a bull. But instead of the market going up, it went below that second bull trend bar. So the market made a 2-legged pullback, and instead of rallying as it should do in a bull, it went down. So I will always short a failed high 2 in a bull, because the market is doing something it shouldn't do. And there will be trapped traders who entered early on that second bull bar at the moving average, and trapped longs, and they're going to exit at 1 tick below that bar, and so I'm going to short right where they're getting out, and they will drive the market down for me. Some of the best trades, you always hear about getting trapped into a trade. Something that's equally common is getting trapped out of a trade. A lot of times the market will scare weak traders out, and that's especially true at the very start of a significant move. So at the bottom of the day here, you have a high 2 and a possible low of the day on that 4th bar. But immediately after that second bull trend bar, the market traded down 1 tick below the low, and at that point, a lot of those early longs panicked and sold out. And the very next bar, it went back up again. And what happens at that point is you have all these beginner traders saying, darn, I had a great entry, I may have caught the low of the day, and now I'm out. And they won't be quick to think that, this is a common occurrence, I've been trapped out, I'm going to get back in. So I'm always looking for places where I know traders are trapped out of a trade, because I know they will chase and they'll be looking for pullbacks to get back in. So I will jump in very early. So for example, at that low of the day, I would be buying at 1 tick above the high of that bear bar, because I know that 1 tick low trapped out the longs, and that means there are going to be a lot of people trying to chase the market up. There's also a second trap there. There's a large bear trend bar that I'm sure scared a lot of longs. And they were thinking that, oh my gosh, the market, look at the size of that bear trend bar. The market must be going down now. But to me, you have a high 2 at the moving average. I'm going to be buying that. You have a strong move up from the low of the day, possible trend day, and you have a high 2 at the moving average and a good bull reversal bar there. I'm definitely going to be looking to buy that high 2 despite that big, ugly, scary bear reversal bar. As a beginner, you should be looking for only 2 types of trades. Until you're consistently profitable, you should only be looking for 2 types of trades. And the first is trend entries. You should either be buying H1s in a bull or selling L1s in a bear. And remember, the H1s and L1s most of the time are micro trend line failed breakouts. The market pokes above a micro trend line for a bar or 2, and then the trend resumes. The other type of pullback entry that you should be looking for is an H2 in a bull or an L2 in a bear, both near the moving average. And it's hard to be trading with trend because for example, here you'd be shorting near the low of the day, and you had a couple bull trend bars, and you're thinking, oh my gosh, the market might be bottoming. You can't think about that. The market's been below the moving average, for 15, 20 bars, and it's clearly a bear trend. Even though it might be attempting to bottom, you got to be automatic, and you got to be shorting the L2s. With trend entries, they always look bad. For example, in a bear, you're always being forced to sell at the low of the day, and it's counterintuitive. You're thinking, oh my gosh, the market has got to rally at some point because almost every day it rallies at some point, but not every day. 1 out of every 5 or 10 days, there's a hard trend from start to finish, and you can be fighting the trend. If you do, you're going to bust your account. If you just turn your brain off and just look for L1s or L2s in the bear, and even though you're shorting right near the low of the day, just keep doing it. Just keep doing it, because the market is just going to keep going further and further and further. As all the bottom pickers keep buying, they're all going to be exiting just where you're shorting, and they're going to drive the market down further. And they're not going to be eager to buy again, so there won't be any buyers coming back in right after you short. So you're in a really good position to make at least a scalper's profit. Here's another example. The market's below the moving average, and you have a couple L2s. When the trend is strong, you always look for micro trend line failed breakouts. For example, in a bear, those are L1s. And sometimes, if you're looking for pullbacks and they're not happening, sometimes you can flip down to a 3-minute chart. Rarely to a 2-minute chart or a 1-minute chart, but I would only do that if you're a really great trader. If you're only making money, 1 day a week, 2 days a week, I would just pick one chart and stay with it, and don't worry that there aren't enough setups. Your goal is first to get profitable. But if you're making money, 95% of the days, then yeah, you can dial down and look for with trend entries on smaller time frame charts. For example, like a 3-minute chart. So here's an example of a 3-minute chart with lots of micro trend line shorts. The second type of trade that you should be looking for are reversals. There's one point that I want to make, and I can't stress enough, that you should not be trading reversals until there's first a break of the trend line. So in a bear trend, you don't want to be looking to buy until first there has been a rally of sufficient strength to break the bear trend line. And after the break of the bear trend line, you're waiting for a test of the bear low, and that's what you're going to be buying. Sometimes the test will go to a new low, in other words, make a lower low. Sometimes the test will not go below the prior low, and you'll have a higher low. In this particular trade that you see there with the green arrow, that's a very weak looking rally that broke the trend line, and the sell-off down to that green arrow is still pretty strong, and there's not much strength during that sell-off down to the green arrow. The reversal bar is very weak. It has a bare body. So when I see something like this, yes, I'm going to trade it. I'm going to buy that, but I'm only going to scalp it because I'm not expecting the market to, turn into a bull trend. There just has not been enough prior strength in the day, at any point during the day, for me to start thinking that, oh good, this is a new bull. It's just a counter trend scalp here. Okay. There's another type of reversal entry that I like, and I call it a failed final flag. After the market has trended for a bit, a lot of times it'll form a flag, and then it will break out of the flag for 1 bar, maybe 2, 3, or 4 bars, and then form a reversal. So here there are a couple examples of that. The first one is the bull trend. The market went sideways for about 4 bars, broke out, and that flag, a lot of times these final flags tend to be horizontal, and horizontal areas are areas where the bulls and bears are in balance, so there's kind of a magnet there. So if the market breaks out of an area that is a magnet, there's a pretty fair chance that the first reversal of the breakout is going to be drawn back toward that magnet. So for example, that red arrow at the top, I will be looking to short the first reversal down after the market broke out of that small bull flag. And then in the middle of the chart, the market's been going down, and then it went into about a 10-bar sideways to slightly up trading range. When I see those trading ranges with lots of overlap after a big move, I'm thinking that this might be the final flag, and I'm going to look for it to fail. So I'm going to be ready to buy the first reversal after the breakout. Here's another example. Another type of reversal that I will trade is if there's a trend channel line overshoot that fails. So for example here, I drew a trend channel line across the highs, and at the red arrow, there was a bull trend bar that poked above that trend channel line, and then you had a bear inside bar on the very next bar. I'm going to be shorting that, and whenever I see a trend channel line overshoot that fails, I'm typically going to look for 2 legs down. Right after that red arrow, about 4 bars later, you see a nice bull reversal bar, except that it's overlapping the other bars. So it's an area of, it's in a trading range, and you don't want to be buying the top of a trading range. It's a high 2. And you think, the market has been rallying since the open, and now we have a high 2, and this is a buy. It's not a buy because you had a reversal. That trend channel line overshoot that failed means that you're now in a bear phase, and you don't buy high 2s in a bear phase. You're expecting after a climactic move like that, there should be at least 2 legs down. So I would not be looking to buy after a climax. Okay, now after a trend line break, as I said earlier, that is the first sign of counter trend strength, and that makes you start to look for a test of the old trend, and then if that test fails, it sets up a trade in the other direction. So on the far left of the chart, you see bar 1 broke a bear trend line, and then there was a rally to a lower high, which is the test of the old bull high. So I'm going to be shorting that test. You have a trend line break, and then you have a test of the old extreme. Here, the test did not exceed the prior extreme, and I'm going to be shorting it. Typically, there'll be 2 legs down. On a lower high, you've already had 1 leg down to bar 1, so I would expect at least 1 more leg down. And then at the bear bottom, you have a break of the bear trend line, and that tells me that I should start looking for a test of the low, and then a reversal up from that test of the low. Here there is a lower low, and I would be looking for two legs up from the lower low. Unlike the top on the far left, the first leg, the top on the left was a lower high, so one leg down had already occurred. On the right, you have a lower low, and there will be two legs up from there almost always. And again, do not trade counter trend unless there has been a trend channel line overshoot, or unless there has been a break of a trend line and then a test of the extreme. The perfect test of the extreme is a two-legged test. Like at the bottom here, you have a trend line break, and then you have two legs down. That is a perfect kind of reversal that you should be buying. It also, whenever you have that kind of a situation, you have three pushes down, which is a classic reversal pattern. Sometimes it has a wedge appearance. Anytime I see three pushes, I always treat it exactly like a wedge reversal. It doesn't matter if it's not wedge shaped. Three pushes is a wedge. Here's something interesting. You have three pushes up, no really good trend line break, a lot of bull trend bars, and notice that at bar 3, it did not overshoot the bull trend channel line drawn from the tops of bars 1 and 2. So that would make me nervous. Also, the reversal bar was not good. Bar 3 was an outside bar down. I would not be shorting that because I prefer to see an overshoot of the trend channel line to tell me that the market has gone too far. Here you have an undershoot, and that tells me that the market may have further to go. So I would look at that as a buy setup. And the traders who shorted bar 3, I would be looking to buy on the resumption of the trend, the high one that occurred a bar after those shorts entered. Bar 5 did overshoot a trend channel line, so that is a good short setup for me. You had a bear inside bar after it. That's a good setup bar. In trends, beginners tend to be looking for reversal patterns all day long. And here's an example of a 120-minute E-mini chart. The market arguably was trying to form head and shoulders patterns all the way. And if you're going to be looking for head and shoulders reversal patterns, if you're going to spend your time looking for reversal patterns, you're going to lose money, because most trends continue and most reversal patterns fail and become with trend setups. So I don't look for reversals unless there's been a clear trend line break or a trend channel line overshoot. But just patterns, reversals that are occurring in the middle of a trend without trend line breaks and without trend channel line overshoots, they're just with trend setups. I just look for where people would be placing their protective stops after they entered, and that's where I'll be getting in. I'll be getting in where they're getting out. This is just an example. Bar 6 was a good momentum move up. It at least tested the trend line drawn from bars 2 and 4. Bar 5 at the low was a trend channel line overshoot that reversed up. So you got two things indicating strength. And then you had a two-legged move down to bar 9. And you broke a couple more small bear trend lines along the way. And then bear 10, you had a little higher high. That's an absolutely perfect long setup. There's also a double top bear flag at bars 11 and 12, which is a good short. Okay. Second entries, if you're trading reversals, second entries are always the very best kinds of entries. So in other words, if the market makes one entry and it doesn't look all that good, don't take it. Wait for a second entry because usually the second entry will work. So those two green arrows at the bottom, those are second entries. In other words, there was a bar that went above the high of the prior bar for the first entry. That failed. I will be buying the next time the bar goes above the high of a prior bar. And at the top of the chart, there was a red arrow. There was a bar that went below the low of the prior bar, and the market poked up to the bar where that red arrow is. That first short entry failed, but I will short the second entry. So counter trend entries, the second entries are always best. Now here at bar 2, you broke a bear trend channel line, and that is a reasonable buy setup. There was also a little reversal bar there. Bar 3 broke. I'm going to speed up now because I'm running out of time, and I know there are other presenters. Bar 3 broke a bull trend line, so of course I'm going to be looking for a test of the low to buy. And bar 5 was a second entry long and a lower low. Because it was a lower low, you should get 2 legs up. If it was a higher low, you would expect only at least 1 leg up. These charts also have a lot of self-explanatory things on them. Double tops are very common flag setups, and when there's a trend, I'm always looking to short double tops in a bear or buy double tops in a bull. The open is very, very important, and there are tons of trades. Basically, I'm looking for a breakout of something from the prior day, a swing low, a swing high, a trend line, a flag, anything. And I'm looking for the breakout to fail, an FBO, failed breakout, and I'm also looking for a BP, a breakout pullback. Those are both good entries for me. I told you I trade stocks. Apple, for example, I pretty much trade it every day. Almost always there's a $1 move sometime in the middle of the day that I like to trade. Okay. Sometimes when the market is just trending forever, you're wondering when is the trend going to stop. A lot of times it'll stop at a bear trend channel line. So, for example, I would draw the bear trend line from bars 2 to 3, and I'll drag it to the lowest bar of the day, which was bar 1, and then see where it extends down to the right, and you can see the market reverse on a perfect test of that bear trend channel line. When the market is choppy and sloppy and sideways in the first hour or two, it's not going to be a trend day, so I'll be looking to trade in both directions. On the other hand, there are many types of classic trend patterns, and I have a classification of them, and anytime I see any of the classic trend patterns setting up, I will force myself only to trade with trend. So for example, this is a spike and channel bull. There's a spike going up, and then it channeled, and I'll only be looking to buy. Spike and channel bulls, I've been telling my friends for the past 6 months that the Dow is going to drop below 10,000 because here's the E-mini, a monthly chart of the E-mini. It's a spike and channel pattern, and spike and channel patterns almost always come back to test the low of the channel, the start of the channel. In fact, the market has extended much further below that. A gap can be the spike part of a spike and channel day. And again, when there is a trend, you have to force yourself to take all the with trend entries and swing part of it. On a trend day, always be thinking that you should swing part of the trade. And this is one of the strongest types of trend days. I call it a trend from the open type of trend. I don't have time to go into all the details of the trends, and I'm going to tell you something I really don't want to tell you, but I'm going to tell you. I explain all this stuff in my book. When you write these trading books, you really don't make much money because there aren't that many people who buy them. But I wrote it because it was a fun project, and I've always wanted to publish a book. I've published lots of articles. I've published a lot of medical articles as well, and I've always wanted to write a book, so I wrote it, and I'm hoping that it answers everybody's questions. Another typical type of trend day, the market sells off, then goes sideways, and then the trend resumes later in the day. Another typical type of trend day, a series of trading ranges here. You have one trading range, and then it fell down into another trading range. This particular type of trend where you have trending trading ranges almost always has a reversal at some point during the day. Now I am out of time, and I'm going to stop here. And Ginger has asked me to stay around for a little bit to answer questions, which I will be happy to do. And I'm hoping that there is enough information on the slides that I passed quickly over so that they'll be self-explanatory. And again, thank you very much, Ginger, and thank you, Futures Magazine. And I'm hoping everyone understood what I was trying to say. Bye-bye. I have a list of questions in front of me, and I'm going to read them and answer them. First question, have you programmed TradeStation to generate these signals? Yes, I have, but I do not use TradeStation to generate the signals. There's also a question about, do I use NinjaTrader, and why? Why would I not use it? I'm a minimalist in everything that I do. As you can tell, I trade 5-minute charts without indicators. So everything I do, I want as few distractions as I possibly can have, and I just don't want to think about anything other than reading the price charts. And I also want as few moving parts operating at any one time, because everything that moves has a chance of going wrong. And if I have a big position on, I just don't want too many steps in the process. And using TradeStation to generate and place trades, and using NinjaTrader, it's an extra step. I can place the trades directly, and I can quickly enter my stops and my profit targets, and I prefer to do it that way. How many points a day can a good trader expect to make? When you're talking about a good trader, I think what you're asking is a great trader. A great trader, I have a friend who says he makes about 20 points every day. If he does, I've never seen him trade, so I don't know if it's true, but I do know that it's possible. A really consistent trader who's making money, 4 or 5 or 6 days out of 6 or 7. If they're making money on 80% of the days, I would be surprised if they're making fewer than 4 points a day. I do know that it's possible to consistently make 6 or 8 points a day, and I believe it's possible to make much more than that. A point that I stress all the time is you should not focus on the number of points. You should focus instead on consistently becoming profitable, because if you can consistently make only 1 point a day and you trade 25 contracts, you're going to be making a very good living. So to me, it's much more important to become consistently profitable and increase my volume than it is to be less than absolutely perfectly consistently profitable and trade smaller volume. I don't like losing. I like winning, almost on all the trades, and I prefer to trade big volume. How long a day do you trade? I typically trade the entire day up to the final 5 minutes of the day, and I oftentimes will take trades in the pre-market, in the Globex, for an hour or so, hour and a half or so before the market opens. Typically when I do that, I trade much smaller positions. What is the name of the book again? It's Reading Price Charts Bar by Bar. It's easy to find. Just go to Wiley.com or Amazon.com and just search my name, Al Brooks. I don't know why the book is not coming out until May. Everything that I have to do with the book, I believe, is done, and it's entirely up to the publisher as to when the book will come out. Why is the close the most important, and is it important just around certain areas like day, high, and low? I think the close, to me, obviously everything is important. The single most important thing to me is the close. I want to see how the bar closes. I want to see if the bar is just a doji bar, which is a trading range, a 1-bar trading range, or if it's a trend bar. And if it's a trend bar, how large the body is, how big are the tails. It's an indication of strength of bulls or the bears. Clearly, when I'm placing trades, I'm relying on the high and low. For example, if I want to buy, I'll buy 1 tick above the high. So, the high obviously is important, and the same with the low. The open is not that important, except in relation to the close, because the open and the close determine the size of the body, and the bigger the body, the more either the bulls or the bears control the bar. You said just the 20 EMA and bar charts are all that you need, but you also showed some candlestick charts. Do you use candlestick charts? Most of the time, in fact, pretty much all the time, for my E-mini trades, I use 5-minute candlestick charts, and that's because a lot of my trades are just scalps. When I'm trading stocks, and I almost always make at least one stock trade a day, I'm looking for a swing, and I just use bar charts. And the reason I use the bar charts is on my laptop computer. I have a 15-inch monitor on my computer, and I can fit 6 small bar charts on the screen at a time, and I can quickly see what's happening. And I'm not as concerned about scalping. And how should I say this? When I'm swing trading, all I need is a bar chart, and when I'm trading stocks, I want to have several to choose from, so I have 6 up there at a time. If I were just trading a single stock like Apple, I probably would have a 5-minute candle chart up there, because the trend bars are much more obvious on a candle chart. Is there a way to get a copy of these ES charts? It's all in the hands of Futures Magazine, and my guess is that they will keep them online. With a large increase in the number of traders adopting your style, will this lead to other large traders to try trade against the stop orders? I wouldn't have written the book if I thought that it was going to put me out of business. I believe that I've looked at charts going back 100 years, and if you don't look at the dates and you don't look at the price scale on the right of the chart, they look the same as charts today. And I'm not the first guy to figure this out. Pretty much every smart trader in the world knows everything that I said in the seminar, and they're already trading it. So by me writing a book explaining it, I'm just not concerned that it's really going to change things. Most of the trading volume out there is institutional, and I wouldn't be surprised if more than half of it is electronic. So I'm just not worried about another 500 or 1,000 contracts of E-mini trades taking place. I'm just not concerned. Also, I got to say, as all of you know, just knowing something is very different from doing something. If Yo-Yo Ma gave you a cello and 10 hours of instruction, you would not be good enough for people to start paying you to listen to you play the cello. And by me simply telling you what I do is not enough for you to start making money. People are not going to start paying you for doing it. It just takes a lot of practice. It's hard to do. Roll down to some more questions. It seems like you use a fair amount of intuition to use make your decisions. Yes, that's true. But as a beginner, until someone is consistently profitable, they would be much smarter to not think too much and instead just wait for second entries, like a high 2 near the moving average and a bull. Your goal should be to become consistently profitable rather than trying to catch every trade and every signal. Because if you try to catch every signal, I believe that you will lose money, and during the course of the day, the losses will just add up and add up and add up. For a beginner, I would much rather that the beginner trades looking for just maybe 3 trades a day, 4 trades a day, and trade a minimal position size, like one E-mini contract. If you want to be able to scale in and scale out, for example, if you think you may have caught the high of the day and you want to hold part of your position, then just trade the spiders, the SPY contract. 500 spider shares is the same as one E-mini contract. So, for example, you could trade 300 spiders and then take 100 off after a 10-cent move, take another 100 off after a 20% move, move your stop to break even, and just let the rest ride. Do you ever stay in a trade for several hours? It's just not my nature. I'm so controlling and I'm so much into micromanagement that that would be very rare for me. Sometimes with a stock position, My swing portion may stay on for more than an hour, but more likely I would be out. Do you draw trend lines on the chart or just eyeball them? The vast majority of trend lines I do not draw because they're perfectly evident with just eyeballing. The most common time that I draw a trend line is when I'm looking for a 3-push pattern and a fade trade, a counter trend trade, because I will rarely ever take a counter trend trade off a 3-push pattern or a wedge unless the third push touched or went through the trend channel line. Do you vary your position size for different entry signals? For the most part, no. What I do is I have a position size that I'm comfortable with, and I cut that position size in half, and I trade that half size all day long. But if I'm at a place where I think there's going to be a major move off the signal, I will trade the full position size. And when I do, oftentimes I will not scalp out at one point. I'll keep the entire position on, and I may not take any profits until a 3 or a 4 point move, and that'll be my first profit target. But on a major reversal, I want to make sure that I have my full position size on at the start, and I want to get as much out of the trade as I possibly can. If your profit target is hit but there's no fill, what do? If it's a scalp trade, which is what most trades are, I will move my protective stop to break even, and then I will be out of the trade either on the profit target getting filled or on the break-even stop. When I'm out, I'll just cancel the other order and just wait for the next setup. What is a reasonable goal to set for a winning percentage? If you are a scalper and you're risking more than what you are planning on winning, you obviously need a very high winning percentage. I think beginners are much better off either just scalping the very highest percentage trades and just scalping a few a day, and it would not be too hard to get a very high winning percentage. I know one trader who wins 90% of the time. I think any really good trader who's picking his signals correctly, day trading, should be able to win at least 70% of the time. And if you are swinging part of your position, that puts you in a good situation for being consistently profitable. If you're a swing trader, obviously you can win less than 50% of the time and still do very well. You just have to do the math to figure out what you need for a winning percentage based upon your stops and profit targets. Okay, do you have the setups structured in the book so you can get good at identifying each of them? I think the book, I organized the book. I'm really happy with how the book turned out. I think it's organized very well. It's very clear. It's very hard to read because it's filled. I don't know how many charts it has. It has 150 charts, maybe more. And some of the charts have 20 different numbers on them. And the name of the book is Reading Price Charts Bar by Bar, and I go through the charts bar by bar. So there's a lot of information there. How often do you reverse your trades? I would say that I take a reversal trade, maybe once or twice a week. Usually, what will happen is I'll see the trade going bad, and I'll be anticipating reversal. I will stop myself out or exit my original position before the reversal entry is hit, and then I'll take the trade in the opposite direction. Okay, are the ticks each move? Okay. When I use the word tick, I'm referring to the smallest price movement for that particular symbol. For example, in the E-minis, a tick is 1/4 of a point. In the spiders, a tick is a penny. In most stocks, a tick is do you have a website? No, I do not have a website. I pretty much am a trading recluse. I rarely come out. This is very atypical for me to be out here giving a presentation. And I don't tutor. I don't have a website. Maybe someday in the future I'll do that. But I view everything as a distraction, and I trade best when I don't have any distractions. Do you wait for a price to touch the moving average? If you're a beginner trader and you're looking, for example, in a bull market to buy a high 2 pullback, it's nice for the pullback to hit the moving average. However, if the market is very strong, a lot of times the high 2 will form well above the moving average. I would not recommend taking that until you're a consistently profitable trader. Until then, I would wait for the price to reach, come very close to the moving average and preferably poke through the moving average, before the high 2 sets up. Is there an archive for review? Again, I believe Futures Magazine will keep it on their site. Is the system also applicable to the NQ? Yeah, you can look at pretty much. In my book, I have one chart of different markets with the name of the chart and the time frames removed. And one of the charts was a monthly chart, and one of the charts was a minute chart. And if you looked at that figure in the book, you would not be able to tell the difference between the monthly chart and the 1 minute chart. So price action trading works on all time frames, and it works on all markets. So yes, it works on NQ. You would have to figure out the profit targets and protective stops, for the NQ. I essentially never trade the NQ. Why do you favor 5-minute charts over a tick chart of a comparable duration? That's because tick charts ignore time, and I like structure and I like time. And I watch the charts bar by bar. I watch the charts minute by minute, and I'm paying attention especially to the close of the 5-minute chart. And I know when it's 3 minutes. I know when it's 4 minutes. I know when it's 5 minutes. I just feel a lot more comfortable being able to anticipate, counting down, and I can't do that on a tick chart or a volume chart because they exist in the absence of time. Also, on 5-minute charts, the trend channel lines and trend lines are incredibly precise, and that gives me more confidence in my setups. So, I haven't tested trend lines and trend channel lines all that much on tick charts or volume charts. So my guess is that they're not as perfect as they are on 5-minute charts. Do you use multiple time frames to help with your trading? I do not. I trade off the 5-minute chart. If the trend is very, very strong and I want to get in, for example, a strong sell-off and a bear, and I know that there aren't going to be any 5-minute pullbacks for a long time, I'll flip up a 3-minute chart or sometimes even a 2 or a 1-minute chart to find a low 2 short or even a low 1 short, because I want to keep getting in the market to make sure that I don't miss a great move. I never use smaller time frame charts to go counter trend. I only use them for with trend trades. I look for places where the counter trend traders would be placing their trades. I'm expecting that they will lose, and I look for where their stops will be, and that's where I'll place my entry order. I want to get in right where they're being forced out with their loss. As far as higher time frame charts go, I do occasionally trade some options off daily charts or even monthly charts. Just naked put buys or naked call buys, and also rarely I'll trade some stock positions off the daily charts. But I make most of my money just day trading off the 5-minute E-mini chart. That is the list of questions that I have in front of me, and I thank you all very much. And good luck to all of you. Thank you. Bye-bye.